Well, folks, we have another stock that should not be in your portfolio. And I was going over this because I was asked a question about it regarding a friend of mine. And no, 3M, which the stock symbol is MMM, has underperformed the market by more than 100% over the past 5 years. So this is a stock you want to keep out of your portfolio. And if you want to see an archive of the above average stocks, then go to our site and sign up for the free 2-week subscription, buffettandbeyond.com, and you'll see stocks that should be in your portfolio. And also tomorrow we're going to show a good stock right here on YouTube that you can put into your portfolio. But we'll look at it. We'll look at the numbers. But remember, folks, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. And okay, let's get off the guessing game and take a look at Triple M. And I feel like I've been a Debbie Downer this week, showing you a lot of stocks you shouldn't even be thinking of buying, and yet here's another one of those stocks. Now, 3M is a diversified manufacturer and technology company with operations in more than 70 countries. It's a big company, folks. It's among the leading manufacturers in many of the markets it serves, and the conglomerate currently operates, yes, it's a diversified company, in 4 business segments: safety and industrial, transportation, electronics, healthcare, consumer. Yeah, that's nice, but the question is it making any money? So just for conversation's sakes, I've been telling one of my associates to get rid of this stock for at least 10 years now. And the reason is it hasn't been sold is because this stock has been held a very long time in the family's portfolio. And if they sell it, they have to pay taxes on it. They bought it that long ago. But folks, let's compare this stock to the average stock out there just by looking at this chart. Now, the vertical blue line is the average stock, and the green line is the 3M company, or as most people call it, Triple M. And the first thing you want to see is that the average stock is giving you a return on equity, think about your bank account, of 13.5%. So bank account, average stock, giving you 13.5%, where 3M is giving you 11%. So why would you put your money into a bank that's making less than average? Folks, you wouldn't. Now, let's go to net income, which is the center blue line there, and we can see the average stock is paying about, or has net income profit of about 13%. Now, folks, you don't see a green line there. The reason you don't see the green line there is because Triple M over the past 5 years has brought in no profit. So what you're looking at here is a negative 0.7%, which doesn't even show up on this chart because it's that close to zero. Moving to the right, we're looking at revenue. Folks, it's bringing in about 1/3 the revenue of the average stock. So why in the world would you put this stock in your portfolio? So just looking at these numbers, just looking at this chart, you know enough not to buy Triple M. But let's look and see how it's performed over the past 5 years. Well, folks, the black line is the S&P 500. Remember, this is 5 years. Black line's S&P 500, returning 60% over the past 5 years. And this yellow line down here is Triple M, and folks, a negative 45%. That's a difference of 105%, folks. Now, I know it pays a dividend that's close to 6%, but 6% a year, which, don't forget, there's double taxation on dividends. The company has to pay taxes on that profit, and then when it gives it to you in the form of dividends, you pay taxes on that dividend. So, folks, there's no win-win here. In fact, it's lose, lose, lose. So we don't like Triple M. You got to keep it out of your portfolio, folks. Why put a below-average stock in a portfolio when you're trying to make above-average returns? And the good stocks that we talk about, well, our portfolio over since 2002, folks, we are looking at 21 years here. We've returned about 16% a year by a whole portfolio. We have 30 stocks in the portfolio. S&P 500, 9.7%. So we're making about 65% more per year simple returns. Compounded returns, if you put your money in at the end of 2002, you'd be up 1,061%, while the S&P is up 377%. Folks, this is a buy and hold. Our model portfolios, 30 stocks, and yes, you can buy 1 share of Amazon, you can buy 1 share or 2 shares of Tesla. You can do that, folks. You want to be divided over 30 stocks because our returns and our research show that we can make these returns and have made these returns. So, folks, our model portfolios are showing 3 times more than the average stock. And remember, 96% of professional money managers cannot outperform the S&P 500 right in here. 96% cannot outperform, and these are people who manage the publicly traded mutual funds. Over any 10-year period, they cannot outperform the S&P 500 index. And here we are showing you that you can do it. Just follow our model portfolios. So, folks, if you want to see the archive of above average stocks, then go to our site, sign up for the free 2-week subscription. That's all it takes. BuffettandBeyond.com. Buffett is spelled with 2 F's and 2 T's. BuffettandBeyond.com. Sign up for the 2-week subscription. Give us your name. Give us your email. That's all we need. And then we'll go from there. So, folks, remember, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett.